Just so people understand the Treasury auctions, tell us how that works.
The U.S. government raises its, debt by issuing bonds and notes.
Uh
The
huh.
bonds are the longer term, notes are the shorter term securities. And there's an auction process where the government actually allows investors to set the price. And so it's not the government setting the price, it's the market that sets the price. And those investors say how much or what rate they're willing to accept on the coupons of those bonds. And so that process goes on, on a weekly basis and is a very regular and important part of a functioning government issuance process. And those numbers that they are auctioning have been getting bigger and bigger. And so, there's been speculation by newspapers and pundits about, how much is too much? Is there a point at which the auctions become too big and, there just won't be appetite for them, or investors will start demanding a much higher premium? Those are things that I think people are watching closely. So far, not much of an impact. Even this week, it looks like, everything is going well and there won't be any unusual situations.
Okay, so let's say, we do know obviously okay, let's just take the position that there is this spiraling and unsustainable debt levels by our government. And if that's the case, how do we position our investment portfolios for that risk?
That's the question, Buck. You hit it square on the head. Is, if an investor wants to think about, okay, this may be a small likelihood or a small chance of happening, or maybe some investors think this could be a very, considerable chance that something like this happens. That's something that they should reflect in their investment portfolios. And if you want to kind of think through, if you've got spiraling debt, there's probably a lot of pressure for the government to contain that through potentially, lots of printing currency. So that's, going to instigate maybe a lot of inflation. You're going to have a situation where interest rates are probably going to be high because, again, a lot of debt out there, and high inflation is going to lead to a situation where you've got high interest rates. You're going to have, a situation where the economy is probably going to have a tougher time with that kind of cost of capital. So you want to think about hedging a little bit or a lot, depending on your perspective and how much you want to think of this as a likely scenario. But typically, real assets do the best in those kinds of situations, right? So they inflate with inflation. If you can get real assets, and that can be gold, by the way, that can be real estate, that could even be aviation fund that we've been talking about to your investors on the aircraft. But assets, hard assets, that will appreciate in an inflationary environment, and particularly those that are leverageable, because in that type of environment, you want to have some debt. I'm not saying go crazy and over leverage yourself, but have some modest amount of debt, because your assets are going to appreciate, the debt's going to stay the same, and therefore you should come out well there. And then I would say, the tax environment is likely to be unfriendly as well, because again, if you assume that the government needs to raise cash, then taxes are probably already being increased on lots of different corporates and households. And so, looking for investments that generate some tax efficiency. And again, you want to look at things like real estate or the aircraft finance fund, that sort of stuff. So those are the types of things I would look at if you want to make sure that you've got exposure to assets that are going to do well in that environment.